Did you know that millions of Canadians could unknowingly lose thousands from their retirement savings in 2026? Not because of a bad investment, but because of new tax rules quietly taking effect. It's true. While everyone's focused on market trends or inflation, these 10 new tax changes might just be the silent drain on your financial future. Imagine this. You've worked hard, saved diligently in your RRSP or TFSA, and now, just when you're nearing retirement, the government changes the rules. Suddenly, you're paying more in taxes, getting less in benefits, and facing penalties you didn't even know existed. And the worst part, most Canadians won't even realize what hit them until it's too late. But not you. In this video, we're uncovering the real impact of Canada's 2026 tax laws in plain English. Stay with us, because what you don't know could cost you big. Number 1. Lower federal tax rate, a hidden trap. At first glance, the new lower federal income tax rate sounds like great news. Starting in 2026, the lowest federal tax bracket drops to 14%, which means many Canadians will pay less tax on each dollar they earn. On the surface, this feels like extra money in your pocket, and for working Canadians, it is. But when it comes to retirement planning, this change may quietly work against you in ways most people are not prepared for. Here's where the problem begins. When tax rates are lowered during your working years, the tax deduction advantage of RRSP contributions becomes less powerful. You're getting a smaller tax refund today, but your RRSP withdrawals in retirement are still taxed as regular income. If future tax rates rise, or if your retirement income pushes you into higher brackets, you could end up paying more tax later than you saved up front. This shift may slowly erode the value of money you thought was well protected. So what should you do? This is the moment to rethink your strategy, not panic. A lower tax rate may make TFSAs more attractive than RRSPs for some people, especially those early in their careers or expecting stable pensions later. The key takeaway is simple but powerful. Tax rules today shape your retirement tomorrow. Ignoring this change could cost you quietly, year after year, without you even noticing. Number 2. RRSP contribution limit increase. In 2026, the Canadian government is increasing the RRSP contribution limit to $33,810, giving you more room than ever to invest for retirement while reducing your taxable income. On paper, this sounds like a win. More space to save, lower taxes today. Who wouldn't want that? But as always, the story is a bit more complex than it appears, and the consequences could hit hard when it's time to retire. The issue lies in the way RRSPs are taxed. Every dollar you contribute today is tax deductible, but every dollar you withdraw in retirement is taxed as regular income. With the limit going up, many Canadians will be tempted to max out their RRSPs without fully understanding the long-term tax burden they're building. If you're not careful, you could end up pushing yourself into a higher tax bracket in retirement, especially if you have other income sources like pensions, CPP, or rental income. So what should smart savers do now? The best move isn't just to contribute more, it's to contribute wisely. Balance your RRSP contributions with TFSA deposits, which grow and withdraw completely tax-free. Use the increased RRSP room only if it fits your long-term tax strategy. And above all, stop thinking of the RRSP as a guaranteed win, because under these new rules, it's not. It's a powerful tool, yes, but only when used strategically. A bigger contribution limit gives you more options, but also more chances to make costly mistakes if you're not paying attention. Number 3. TFSA limit changes and new risks. For 2026, the annual TFSA contribution limit has increased to $7,000, giving Canadians even more room to grow their money tax-free. At first glance, this might seem like a straightforward upgrade, more space to invest without paying taxes on your gains or withdrawals. But what many don't realize is that with more contribution room comes a higher risk of penalties, especially for those who aren't closely tracking their deposits or understanding how the CRA monitors TFSA activity. Here's the catch. Overcontributing to your TFSA comes with a harsh penalty, 1% per month on the excess amount, until it's withdrawn. And this isn't always easy to avoid. Your TFSA contribution room doesn't update in real time. The CRA only refreshes your available room once a year, usually by April, meaning if you're not manually tracking your contributions or relying solely on the CRA portal, you could unknowingly go over the limit. Many Canadians get caught in this trap early in the year, especially when recontributing amounts withdrawn the year before. So what can you do to protect your savings? First, keep your own records of all TFSA contributions and withdrawals, especially if you use multiple institutions. Second, wait until at least April before assuming your CRA contribution room is fully accurate for the year. And third, don't assume the TFSA is too simple to cause problems. While it's one of the most powerful tax shelters in Canada, it also demands discipline and awareness, especially with more room and more complex transactions. A small oversight can lead to unexpected penalties that quietly chip away at your retirement plans, no matter how good your intentions were. Number 4. TFSA Room Update Delay. One of the most overlooked changes affecting retirement savers in 2026 is the delay in the CRA's TFSA room updates. While your TFSA contribution limit technically resets on January 1st, the CRA doesn't update your official contribution room until sometime in April. This creates a confusing and risky 3-month window where you could unknowingly overcontribute and face steep penalties. Many Canadians assume they can start fresh with new contributions on January 1st, but if you made withdrawals last year and tried to recontribute too early, you may be penalized. The confusion lies in how recontributions work. If you withdrew money from your TFSA in 2025, you can't recontribute that amount until 2026. But if you jump the gun in January before your CRA account reflects your new limit, the system might flag your deposit as an overcontribution, even if it's technically allowed. That's because the CRA doesn't track real-time contributions or account for withdrawals made in the prior year until the annual update is complete. That delay leaves you vulnerable, even if you're following the rules in good faith. The smart move? Be cautious in the first quarter of the year. Unless you're absolutely sure about your available contribution room, including carryover from previous years, it's better to wait until April before making large or complex deposits into your TFSA. This is especially important if you manage multiple TFSA accounts across different financial institutions. One misstep could trigger penalties that accumulate quietly, harming the very savings you thought were safe. This hidden timing trap has already caught thousands of Canadians off guard. Don't let it happen to you. Stay informed, double-check your records, and always remember that with great tax benefits come equally strict rules. Number 5. CPP Contribution Increases. In 2026, the Canada Pension Plan, CPP, is undergoing another scheduled increase in contribution rates and maximum pensionable earnings as part of a multi-year enhancement plan that's been rolling out since 2019. While the government's goal is to provide greater retirement income in the long run, the immediate impact on working Canadians is significant. Both employees and employers are now required to pay more into CPP, and for many, that means less take-home pay today, especially for middle and high-income earners who already feel stretched by the cost of living. Here's how it works. The maximum pensionable earnings for 2026 have risen, meaning a larger portion of your salary is subject to CPP deductions. Plus, there's a new second earnings ceiling, which creates an additional layer of contributions for those making above-average incomes. So if you're earning more than the basic ceiling, you're now contributing at a higher level than before, without necessarily understanding how it affects your future benefits. And for self-employed individuals who pay both the employee and employer portions, this can feel like an especially heavy burden. What does this mean for your retirement savings? While these extra contributions will eventually translate into higher CPP benefits in retirement, they also reduce the amount of money you can invest elsewhere, like in your RRSP or TFSA. That means your overall investment flexibility takes a hit today. And for those close to retirement, the full benefit of these extra contributions may not be realized in time to make a big difference. The key takeaway is this: don't assume higher CPP contributions automatically mean financial security later. It's still essential to have a personal retirement savings strategy in place, one that goes beyond relying solely on government pensions. If this is opening your eyes to things you hadn't considered, let us know in the comments. Which tax change do you think will hit Canadians the hardest? We put a ton of research into every video to bring you clear, no-fluff insights. So if you're finding value, hit that subscribe button. It's just one click, but helps us keep going. Number 6. TFSA versus RRSP strategy shift. As Canada's 2026 tax rules reshape the financial landscape, one of the biggest questions retirees and savers now face is, should I focus more on my TFSA or my RRSP? Both accounts offer tax advantages, but the value of each is changing, and if you don't adjust your strategy accordingly, you could end up paying more in taxes than necessary. With tax brackets shifting and contribution limits rising, it's no longer enough to simply max out both without understanding how withdrawals will impact you down the road. The RRSP has always been the go-to for reducing your taxable income today. But remember, everything you take out of it later is fully taxed as income, and if tax rates increase in retirement, or if your income is higher than expected due to pensions or rental income, those withdrawals could push you into a higher tax bracket. The TFSA, on the other hand, offers tax-free withdrawals, which makes it a much more flexible tool for managing income in retirement, especially if you're trying to avoid OAS clawbacks or minimize taxes in your golden years. So what's the smart move in 2026? For many Canadians, it might be time to shift more focus to the TFSA, especially if you're early in your career, expecting a solid pension, or concerned about future tax rates. The RRSP still has a role, particularly for high earners looking to reduce taxable income now, but the balance between the two needs to be reassessed. It's not about picking one over the other. It's about understanding how each fits into your personal tax picture. Under the new rules, strategic use of both accounts can protect your retirement income far better than blindly following old advice. Number 7. OAS clawback thresholds. One of the most misunderstood parts of retirement planning in Canada is the Old Age Security OAS clawback, and in 2026, the thresholds are rising again, but so is the risk of being caught off guard. Starting this year, if your net world income exceeds approximately $95,000, the government begins to reduce or claw back your OAS payments. And for many Canadians who've saved diligently through RRSPs and pensions, this threshold is surprisingly easy to cross, even without realizing it. Here's where it gets tricky. RRSP withdrawals, pension income, investment income, and even part-time work all count toward your net income. So if you're not carefully planning how and when you withdraw your funds, you might unknowingly push yourself over the limit, triggering reduction in your OAS benefits. And once your income reaches a certain point, your entire OAS payment can be clawed back to zero. That's a hard loss for anyone who was counting on that monthly support as part of their retirement income. The good news? This problem is preventable if you plan ahead. Consider strategies like withdrawing for your RRSP gradually before age 71, using your TFSA for supplemental income, since TFSA withdrawals don't count as taxable income, or splitting pension income with your spouse to reduce your individual income level. The key is to be proactive, not reactive. Under the 2026 rules, ignoring the OAS clawback thresholds could cost you thousands every year. But with smart planning and awareness, you can structure your income to stay below the danger zone and protect your full OAS payments, money you've earned and deserve to keep. Number 8. TFSA over-contribution penalties. While the tax-free savings account is one of the most powerful tools for building retirement wealth in Canada, it also comes with one of the harshest penalties if used incorrectly. In 2026, the CRA continues to enforce a 1% monthly penalty on any over-contributed amount, and this rule doesn't allow much room for error. Even a small mistake, like moving money between accounts or miscalculating your limit, can trigger months of penalties before you even realize what happened. One of the most common ways Canadians get caught is through recontributions. Let's say you withdrew $5,000 from your TFSA in late 2025 and then recontributed it in early 2026. Seems fair, right? But if your CRA account hasn't updated your room yet, which usually happens around April, it will register your deposit as an overcontribution, and you'll be charged a penalty for each month that excess amount remains in the account. The CRA doesn't care if it was an honest mistake. The rule is strictly enforced, and once the penalty starts, it adds up fast. So how can you avoid it? First, keep a personal log of your contributions and withdrawals. Don't rely solely on the CRA portal, especially in the early part of the year. Second, wait until your room is updated before making any large or recontributions. And third, understand that this isn't just a small administrative fee, it's a real financial loss that can eat away at your hard-earned savings. The TFSA offers incredible tax benefits, but it demands careful handling. In 2026, with more Canadians contributing larger amounts, the risk of overcontributing is higher than ever. One simple oversight could cost you hundreds or more in completely avoidable penalties. Number 9. Retirement allowance transfer deadline. If you received a retiring allowance in 2025, perhaps from a severance package, career change, or early retirement, there's a critical deadline looming in 2026 that could determine whether or not you owe taxes on that money. Under CRA rules, you may be eligible to transfer a portion of your retiring allowance directly into your RRSP without affecting your contribution limit, but only if it's done by the strict deadline of March 2nd, 2026. Miss that window, and you could be on the hook for a massive tax bill. What makes this even more serious is how few people actually know this rule exists. Many Canadians assume that if they have RRSP room, they can just transfer funds at any time, but that's not the case with retiring allowances. The CRA gives you this one-time exception based on years of service prior to 1996, and the contribution must be made within 60 days of the new tax year. Waiting too long or failing to act because you didn't fully understand the rules could result in your entire allowance being taxed as income, wiping out a big chunk of money that could have been sheltered for retirement. So what's a smart move? If you receive a retiring allowance last year, act immediately. Speak to your financial advisor or tax professional to see if you qualify for the special transfer, and make sure the funds are deposited into your RRSP by the March deadline. Don't let this opportunity slip by, because once that deadline passes, there's no second chance. In 2026, more Canadians are transitioning careers or retiring early, and the risks tied to these timing rules are higher than ever. One missed date could cost you thousands. Number 10. Provincial tax changes impacting pensions. While most retirement planning focuses on federal tax rules, provincial tax changes can have just as much, if not more, impact on your actual take-home pension income. In 2026, several provinces have adjusted their income tax rates and brackets, and for retirees, this means your monthly pension payments may be smaller than expected, even if your gross pension amount has increased due to inflation indexing. The tax bite from your province could quietly reduce your spending power, especially if you haven't factored in these changes. For example, if you live in a province like Alberta or Ontario, recent tweaks to provincial tax brackets now mean that even modest increases in your pension income could push you into a slightly higher tax range. And because pensions are considered taxable income, these small shifts can have a cumulative effect over time. A few $100s a month might not seem like much, but over the course of a year, or an entire retirement, it could add up to thousands of dollars lost to taxes you didn't plan for. Many retirees are caught off guard when their net payments go down despite an annual cost of living adjustment. What can you do to stay ahead? First, review your province's latest tax updates for 2026 and see how they affect your income level. If you're close to a new tax threshold, consider strategies like pension income splitting with a spouse, withdrawing for your TFSA instead of your RRSP, or deferring certain sources of income to manage your tax bracket. Planning at the provincial level is just as important as planning federally, especially when you're living on a fixed income. In retirement, it's not just about what you earn, it's about what you actually keep. So, what's the big picture here? The 2026 tax changes might seem like just a few tweaks to rates and limits, but the real danger lies in how quietly these changes can erode your retirement savings. From increased CPP contributions and stricter TFSA rules to shifting OAS thresholds and provincial tax impacts, each law on its own might not seem alarming. But together, they create a complex web that demands attention, strategy, and action. If you continue saving and withdrawing money the same way you did 5 years ago, you could end up paying thousands more in taxes without even realizing it. The truth is, the financial system isn't built to make things obvious. The government isn't going to call you to warn you about missing a deadline or falling into a new tax trap. That's why staying informed is your strongest line of defense. By understanding how these laws interact and taking simple, proactive steps, like balancing RRSP and TFSA contributions, tracking your contribution room, and planning withdrawals strategically, you can protect your retirement income and make your money last longer. Remember, the goal isn't just to save, it's to keep as much of your savings as possible. In a world where quiet tax rules can create loud consequences, knowledge is power. So take this information seriously and don't let small oversights chip away at the wealth you've worked so hard to build. We'd love to hear from you. Which of these 10 changes surprised you the most or made you think twice about your current strategy? Drop your thoughts or questions in the comments. We read every one of them. And if you found this video helpful, please support us by subscribing to the channel. It's just one click, but it means the world to us. We put a lot of effort to making these videos just for you.